Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy any investment based solely on a tip or recommendation. Please do your own research.
Hello and welcome to the Midweek Takeaway, and welcome Ed McDermott, CEO of Seed Innovation. How's life treating you, Ed?
Thanks, guys. Yeah, not too bad, thanks. It's been, it's a tricky market out there at the moment for everyone, I think. You know, if you're an outlier in oil and gas or battery metals or something very niche that is getting a lot of love, you know, I think times are still good. But I think for everyone else, investors and management teams, I think it's kind of depressing to look at the stock market, particularly the junior end of the stock market, but also, in fact, your main players in the market as well, because it's tough times, and we're about to head into that sort of drifty summer period after years of people not being able to travel. I would expect people to sort of be switching off quite a lot. Obviously, we won't be switching off, but as we were just discussing a second ago, for me, I can't really look at share prices because they're not relevant. There's not enough volume to support whether they're good or bad trading opportunities, or indeed good or bad companies. I think what really, and this goes across the board, everything I'm looking at, I'm interested in what those companies are doing operationally. And I feel like largely we've got all of our, certainly the vast majority of our companies into a place where they're operationally doing exactly what they're meant to be doing. And in some cases, much better than that. So,
I mean, we speak to a lot of CEOs and they say the same thing is, you could lose sleep at night about the share price, but actually once you get comfortable with that and just carry on, focus on running the company and doing the best for shareholders and what's right for the company, you can sleep better, and it doesn't become an issue.
Yeah, look, I understand it's deeply frustrating for all of us, because it's the measure that people mark your success against, and obviously it's a bit of an unfair time to do that with any company, because the volume, as I said, these things are so thinly traded, or in the case of some of our portfolio assets, they're on really poor exchanges, that have even bigger problems than we've got over here in the UK. So, we've got the Australian Stock Exchange, which is just not going well at all. You've got the CSE, and then more domestically, we've got the Aquis Exchange, which is just, it's always been a bit of a lobster pot in that respect. And it should only ever really be used as a launch pad for bigger things. I like an Aquis, for example, and similarly to the CSE, they're almost where you go to be a private company with a quote. It's not a trading opportunity. So, but you can use it as a growth platform in terms of access to capital. People just psychologically like that thing of having what they think is a liquid asset. Obviously it's not.
Sure. So since we last talked, you obviously had a few updates, namely Yooma and Leap gaming of recent times. Do you want to just talk us through the progress to date?
Yeah, sure. I'll start with Yooma, because I think their recent numbers were extremely encouraging. I think if you look across the CBD and the wellness sector in general, there aren't many companies doing sort of run rates north of $20 million a year. Now, granted, of course, they put a load of impairments into their accounts. They wrote off a load of things. So, the non-cash items looked like a nasty hit to the company, but ultimately the key is that they were non-cash items. So, I'm really encouraged by what Yooma's actually achieving in terms of operationally, its businesses are doing well. And there's going to become a tipping point for all of this. It might be deeply unsexy at the moment, CBD, wellness, but these things are going to come back. They're multi-trillion-dollar industries globally, and it's a matter of time. So the companies that build themselves up during these difficult periods, shall we call them, when it feels like there's tumbleweed in the streets, that's the companies that end up selling for hundreds of millions of dollars down the line. So I think people writing things off just because they're on a weak stock exchange and the share price looks ugly, look at the volume. If there's no volume, the share price is irrelevant. That's kind of the way I think you've got to look at it. Going on to Leap, yes, Leap, the whole goal with Leap, because of the marketplace that it's in, which is obviously the gaming and gaming support space, is ultimately driven by revenue and multiples of revenue. it's a growth company. Therefore, people are not judging it based upon its EBITDA. It is EBITDA positive, significantly EBITDA positive. But ultimately, this company still makes a cash loss at this point in time because of its plans to grow. So we're supporting Leap further with some additional cash. You'll notice that it's not an enormous amount of cash. And we've been very clear about what the plans are for Leap. Obviously, we're in this very difficult marketplace at this point in time. So our goal was simply to get everything organized so that the company is as ready to go as it possibly can be. And then try and pick our timing as well as can be. Now, obviously, things take time, and I'm disappointed that we didn't get things done by, we didn't outperform what we were hoping to achieve in terms of timing. But the company's doing well. It's signing new agreements. It's got recently won its the UK license, which is a seriously important regulatory milestone that allows it to open up a huge amount of gaming real estate. And again, it's just everything is moving absolutely in the right direction. I've been totally honest about this before. It was challenging to sort of get into a position where I had to kind of take on a legacy asset that, at that time I didn't know the deep ins and outs of, but it's taken me quite a long time to really work with all the other team members, work with the management, work with the rest of the board, and of course my own board, and make sure that we have got Leap into the most robust place it can be. And it's a good business.
Yeah. So you're confident that that loan of, was it €250,000 for presumably mainly working capital, and then as they work towards a liquidity event, you're confident that by helping them with that amount, with that term loan, that you will see significant value returned to your investment in the future?
Yeah, I mean, look, there's two ways to look at it. Number one, it's a very important asset to us in terms of our the net asset value that it represents to us. And of course, the percentage that we own of Leap, we are the dominant shareholder by a big margin there. So we view it as our responsibility to make sure that we have that business in absolutely the best possible financial place that it can be, while still driving on this growth. And secondly, we wouldn't do things if we didn't feel like that there was a very good chance of making a good return. Now, again, with Leap, our obsession is not with valuation. For example, when it floats, our goal, to post a big figure and get a deal done at a massive valuation isn't going to help us in the longer run, because ultimately we're a big shareholder in this company. Our goal is that Leap becomes a real stock market hero, i.e. we leave lots on the table for incoming investors, because ultimately that's how you have a stock that goes on to become successful. If you go on at a premium chunky valuation, these things don't trade and it becomes a real uphill battle. Whereas if you leave it as a real momentum stock from day one, that's what we want to try and achieve with it. Just very quickly on that net asset value piece, people who read the announcement in more detail would have noticed that Leap's net asset value had been independently valued and was circa 12% down on the previous year in terms of valuation. And again, it's very simple. If you're a valuation expert, you're a company that provides valuation, independent valuations for other companies. Number one, you want to be conservative. Number two, you have to go and look at all of the best possible metrics you can look at, the data across the market, which inevitably means you look at all the publicly listed companies. And if you look at a Playtech of this world, a monster of a gaming company, 30% down. So of course, we're going to be getting some negative spin on our own valuation. But 12%, I personally don't see that as a major issue. And of course, when you value these companies that have some very, very important IP, how do you value a license? How do you value a UK license? What does it mean to a company in terms of its potential for gross gaming revenue? It's significant. So it's very difficult for them to put a true valuation on it. Is that what we think it's worth? Of course not. But, we're a public company. Our job is to report on what our independent valuers provide. So again, a little bit of negativity around these sort of things, but it's all short term, and it doesn't necessarily it shouldn't be the one thing that leads the market. Certainly if everyone was guided by our NAV, we'd be trading at least twice our current price. So it shouldn't be relevant now, is my point.
Yeah. Ed, just give me an idea where the pennies and cents come from in Leap Gaming. Okay, we're saying it's not quite profitable yet, but where do they make their money?
I should, it does make a gross profit, number one. It is
Okay.
EBITDA positive as well. So let's not confuse it as a sort of a completely loss-making business, because it could very, very easily become a profitable business, but that would probably come at the cost of growth. And given that gaming companies are large, especially growth-oriented gaming companies, are largely valued upon revenue, our goal is to obviously increase Leap's revenue more than any other factor, as long as it doesn't get to a point where it's losing significant money. So just to be clear on that point. In terms of where does Leap generate revenue, well, there's a number of different things, but number one, and I think first and foremost, Leap is very famous for its virtual reality sports. So essentially what Leap does is it goes and takes hours and hours and hours and hours of footage of sports, and it creates virtual versions of those sports, but it's so closely based on real life. It's meant to be a fantastic interactive experience for users. Now, it then provides that software, that IP, to gaming companies that have a consumer-facing platform. So a Bet365, an 888, they will effectively then share in some of the revenue that is generated by those clients. And there's two ways predominantly in which Leap generates its revenue from that. Some of it is essentially fees paid for either licensing or just as to build a specific item, and then of course it takes a percentage of the gross gaming revenue. And then there are various platforms that allow it to generate revenue in other ways, R&D, and all sorts of other things. It's not an uncomplicated business, but its core offering, if you like, is its virtual sports, and of course some of the casino games, the slot games. And then the other side of it is there's just simple game playing, which is effectively monetize gaming, but it's not gambling, so it's just paid for gaming. So that's another vertical that Leap generates revenue from.
And they give that to the companies, and then the company gives that to the customer. They don't have a customer-facing basis.
No, I mean, I can't obviously go into too much detail, but there's lots of plans afoot for Leap, which will see it developing into other areas where it's already got a skill set above and beyond what new market entrants might like to try and achieve. So there's a huge amount of scope for Leap. You've got to remember, it's never really been massively capitalized. It's never had a big injection of cash. It's never had, say, £5 million invested during one period of time, which would allow it to obviously do a number of different things. It's always been around organic growth, and it's been very successful at organic growth. But one of the goals with an IPO or an RTO, for example, is to give it that capital that will allow it to pursue a number of different things, bolster its team, and allow it to essentially scale up much more rapidly than it already has, whilst also building upon its already solid organic growth.
So IPO, RTO, when it happens,
we're not a patient shareholder. We want this company to get moving. We're patient in the respect of we're not looking to sort of get out of Leap this minute. We're patient in that respect, but we're not patient in terms of we've been invested in this company for 6 years. I've spent the last year and a half really spending a lot of my time with Leap and really, doing everything I can to help the management in all the right places. Now, of course, I'm not a gaming expert, but the skill set that myself and my board have been very useful to Leap. We've obviously got great investor partners such as IMG, who are, a very big name, very well known, and they're one of the key protagonists. If you look at their material, their marketing material, Leap's products are featured all over it, with IMG Arena and stuff. So, in terms of an endorsement, you're not going to get much better than that. Some of the partners that Leap already works with, very well-known household gaming companies. There's the US, there's the UK, there's all these other territories that Leap is only just starting to get into, which are huge growth opportunities. So, are we excited? Yeah, we are. But ultimately, we want to see that liquidity event so that the company has the platform to grow. And of course, we as shareholders then have more optionality in terms of what we can do and when we can decide to, reduce our position, reduce our exposure in due course. But it won't be.
Yeah, I suppose that was my question. That Seed has, I think, 43.2% or whatever I think it is of Leap. Are you going to give up part of that at the IPO so that there is a liquidity in the market?
Look, we don't. There's nothing that hasn't been considered in this respect, and I think it's probably no secret that Leap has had approaches by people who would probably like to own the business. In terms of that being formalized to the extent of a final binding term sheet, we haven't ever progressed anything to that extreme. But that's always an option. M&A is something that we've considered. We've obviously spoken to lots of different people in the market, but as I've always said to you guys and anyone else who will listen, as a manager, as a CEO of Seed, my job is to deliver the best outcome, even if I have lots of shareholders, of varying sizes saying, "Oh, I want you to do this. I want you to do this." My job, my fiduciary duty is to deliver the best return possible on big gaming. And that's, at the end of the day, that's my laser focus where it comes to Leap. My job is to deliver whatever the best possible outcome is. And in order for me to do that, you have to really survey all of these different options and effectively SWOT analysis every single one of them.
So from the point of view of the terrible deal that you did last year where you took all cash, how does that deal look now that we took all cash?
Are we referring to EMAC?
We are.
Well, as a Curaleaf shareholder, I can tell you it's pretty painful right now. My stock is worth circa a third of what Seed Innovations managed to sell for. So, look, it's one of these things. We wouldn't have had a choice either way, but we were the only investor that was able to get out in full cash on day one. So again, we always get accused of, there does seem to be an us against them view where it comes to from retail share investors in the market, and the crazy stupidity of it. I would have taken that deal all day long as an EMAC investor. I would have loved to sell out for full cash right then and there. I'd be much more a master of my own destiny financially. So, look, it's allowed us to do a lot of things. It's allowed us to make investments in Eurox. Eurox has been a really good performer for us. We're 60% up on the sort of 3 million euros that we invested there, not to be sniffed at. And that company's going really, really well, despite a really negative sentiment towards the cannabis space, which I think, frankly, is ridiculous, but I can understand why. You've got companies raising significant money and institutional money as well, such as Eurox. So we're obviously getting some things right, and I think we're getting more right than it would appear. And some of it is out of our control in terms of the sentiment in the marketplace, the exchanges that some of these companies are on. But, it's all part of the journey. And again, it comes back to this very simple goal that I always have to come back to, which is my job is to generate the best returns for investors, period. The board think the same way. Sometimes our view will be at odds with shareholders. Sometimes they will think that something is worth much more than perhaps it is, and ultimately you can only sell something for what somebody's willing to pay for it at the end of the day. And, not all that glitters is gold, but equally on the flip side, you have some really unloved assets that will really surprise you over the next, 3, 6, 9, 12 months. But one thing none of us can do anything about is sort of global markets and the sentiment that's there. We as individuals, we can do bits to help and generate some volume. And you'll see just over the last week, we've had about 2 or 3 months worth of volume in about 5 or 6 days in Seed Innovations. Now, yes, that, and very frustratingly, the share price moved up and then it came back down. If that's people exiting, using it as a opportunity for liquidity, well, I'm never going to tell people what they should do with their own assets. Do I think it's wise to be selling the stock at that price? I don't personally. We've got a clear set of businesses and assets that are clearly much more valuable than the market believes they are right now, and that's okay. That we suffer along with many other companies out there. Many other funds have exactly the same problem. It means our time horizons have to move out a bit in terms of when we're expecting to get results, but ultimately I think we, management teams, investors, we all need to remember we're all on the same page. Ultimately, I don't win anything if this company doesn't go on to be successful. It's harmful. So my goal is never ever at odds with shareholders. Ironically, we all want the same thing, which is the biggest possible growth in our share price as we can possibly get. But in order to achieve that, I have to focus on the thing that I can control, which is the actual operational side of these businesses. And again, I can't entirely control that. I can only influence that because in the case of something like Leap, where we have a very big position, we can obviously have much more leverage. In some of the areas where we don't have such big positions, it's much harder to leverage that and put pressure on management teams. And ideally, we need to work with these people, not against them. So, it's a complicated existence, but it's one that, despite the difficulties and the challenges, we relish. And ultimately, the goal hasn't changed.
Well, your net asset value as it stands at the minute, Ed, is what?
Well, I can't give you as it stands from last year, we're still sort of circa 20 million in terms of, and I think, you forgive me, I cannot actually remember off the top of my head exactly.
Okay, but
the price to NAV on SharePad, don't know accurate, is 0.4 at the current price. I think previously our NAV came in at around the sort of 10p mark, and I think probably certainly due to the likes of Yooma, LGP, Portage, all of these things that previously were trading at much higher valuations as public companies have obviously come down. So inevitably our net asset value will be slightly impaired because of that. But again, as I said, a lot of that has to be just taken with a huge pinch of salt, because these things have no real liquidity. It's not like we could sell our position, and in pretty much none of those cases are we interested in selling those positions. So
the scenario is with a NAV of 20 million even, and let's say it's slightly less than that, and you currently have a market cap of 10 million. The issue is, as you said, you don't want to sell these assets anyway because they haven't achieved their potential in any stretch of the imagination. And you, and not every company, but a huge number of companies are in this same situation. We were talking before you came on just to record something else, and we were talking about different resource sector companies, that there's just no logic behind the valuations that they have at this moment in time. None at all. It's just low volume, and the market makers just taking it down. They don't want to hold the stock. So if they don't want to hold the stock, they'll reprice it. Someone will buy it cheap, and that's where we're going.
That's how you can't fight the tape. At the end of the day, sometimes you have to sort of turn your screens off where it comes to share price and start looking beyond that, because ironically, these are the markets where people actually make more money than they make in a bull market. Because you start buying things in a bull market, you're probably paying right at the top of the goal here is to buy assets as cheaply as you possibly can, good assets that you've thoroughly researched, that you thoroughly understand. And the great thing about being a public company is that we have to provide all this, and we have to evidence the things that we say. I can't just say, I think this is worth $1 billion. There has to be some. I can have a personal opinion, of course, but ultimately, it has to be based in some sense of reality here. What can you do about? Sometimes you just have to ride these periods out and make wise investments, and that's where you ironically make a huge amount of money and excellent returns on the other side of things. At the moment, if you look at the fear greed index, we're in extreme fear. Now, I think really useful tool. This, it's somewhat vague, but we've gone from extreme greed to extreme fear. Now, normally when you start getting into that period of time, as long as when you build your positions in things, you don't just necessarily go in and go, right, I've got 100,000 to invest, bang, done it all on day one. You might do it in 10,000 blocks. If it comes down a bit, the thing that you're particularly interested in, you buy a little bit more. You do it over a period of time. Yeah. If miraculously you time it well and the market starts to roof as you're doing it, well, that's fine. You don't mind paying a little bit more on the average on the way up. But it's all about patience, and it's all about sticking with your view. If your view is affected so greatly by all the noise, all the message boards, all of this, then you're probably not a very good trader. And, maybe it's not the right thing for you to be doing. Put your money with somebody else who has a sort of track record in it. But, if I listen to every differing opinion every single day, I'd never make a decision. And I think that's why you have to take it on yourself to go and do the research, to understand the people, to understand, what have they done before? Have they had some success? Have they had nothing but disasters, one after the other, after the other, after the other? There's normally some good evidence that you can go on. And then, of course, you've got your market themes. At the moment, we've got global food issues, food security issues, supply issues. We've got supply chains in just about every industry are massively affected by, Ukraine-Russia saga. And that is, 30%
of grain issue. So you'd be looking at fertilizer companies like Emerson and people like that, I guess.
Well, I'm very fond of Emerson for obvious reasons. As a founding member of that company, that I believe that's going to do very big things. But that's it. These are all very good examples. As I said, 30% of the world's supply chain is currently offline. That's going to have major impacts all over the place. We've got all the issues, all the fallout from COVID. We had a massive bull market through that whole COVID situation, and we're sort of paying the piper here a little bit. But if you're sensible and you took some money off the table when things were getting, so shall we say, peaky, you should be in a good position now to just having that patience and sticking with the view. If something material changes and fundamentally you disagree with the view that you had before, that's when you make changes. But for example, where it comes to bring this back entirely to seed, we still believe in the things that we invested in, regardless of what market sentiment tells us. Because, I have to look at what is the underlying market. Cannabis, for example, is medical cannabis growing globally? Yes, it is. Are prescriptions growing globally? Yes, they are, significantly, big numbers. We're not talking, single digit growth here. We're talking double digit growth in a month, every month, compound. You can hate it all you want, but that eventually that comes home to roost, and suddenly you're going, oh, geez, this is a rather large market. These companies are making some money now. But even Invenium, which came out of the disaster that we had with our dear blockchain company Factum, which effectively gave us a net loss of $6 million. Invenium's doing extremely well. With the right management team, with a technology that was clearly very good, and making it work. And watch this space. Our value in that, not to get anyone too excited, it's not anything like $6 million just yet, but it is certainly growing. And these things are very, very encouraging. Juvenescence, people have forgotten about this entirely. Longevity for the world, for all of us. Living longer and living healthier for longer, being able to do more for longer. That's not an insignificant investment. It's like $4 million for us. But again, you start piecing all these things together, even at their depressed rates, and you come out at a much bigger number than we currently trade at. That's fine. Do your own research, look at these things, but you have to sort of take some personal view and personal understanding of these things in order to come out at a sensible valuation. And as I said, we think we're in the right places still. We believe that when things are deeply unsexy, that's an even better time to be investing in them. You can build a really nice position in things, as long as you take the time to look across the market, understand the management teams that you're working with, understand what their real capital requirements are going to be going forward, and what chance do they have of being able to get hold of that capital. If you're confident in all of those things, largely it's then just a question of time. And I guess we've all got to be a little bit more patient, unfortunately, just because of the way the market is right now. It doesn't mean we work any less hard. It doesn't mean we sit and do nothing.
It's a classic, isn't it? The hardest skill for a trader to learn is patience. And there's
absolutely
so much truth in that.
Yeah, I mean, look, I'm bizarrely, a lot of my best friends are, for example, oil traders at very big houses like Vitol, Glencore. You know, these guys, they really, you know, they put the time in, they really understand their market, they really understand what they're doing. And just because their buddy tells them something different to what they think, they don't change their view unless fundamentally something changes. And that might be a Russia-Ukraine situation. But, you know, normally you can see these things unfolding and you can plan for that. So, yeah, look, I'm still buoyed by what we're doing. I still am absolutely certain that what we have is going to come good, and it's going to come good in a meaningful way.
Good. Well, now we've put the world to right, Ed. I think we've had a bit of a rant about the whole everything. We've done geopolitical issues, we've done the markets, but it's been good. Always good.
I have one question left to ask, Ed. Does Seed still have cash to displace, as in to invest in stuff?
We do indeed. Yeah. I mean, it won't be long before you see some new investments as well, I think is the best way to put it. So we aren't, as I said, just sitting down doing nothing. We're looking at more opportunities than we've ever seen. Granted, many of them are non-starters because for a lot of reasons, we don't believe that they're going to be able to secure the kind of capital that they need to flourish and ride out these tougher markets in some cases. But we have some very, very, very interesting things that we're looking at. We have some, you're going to see some news soon on new investments. So yes, we do still have cash, circa, call it $1 million or so, but we also have other things that could easily give us more cash should we need it. So, and that doesn't, for the record, include raising capital or debt or anything in that respect. So just to be very clear before anyone thinks.
Someone sending you brown envelopes
this is literally
in the post.
But we're in a fortunate position. We don't have a big burn. You know, I'd sooner personally just take no salary, take nothing, cut the costs than do anything rash like that. We just don't need to do it. We've got assets that are well in the money. So were we in a position where great investment opportunities came up, we would sell things to fund those new things. But we don't need to do that at this point because we still have sufficient cash. So
good.
Yeah, on that front,
good.
Very, very content. Obviously, we'd like to have more cash. We'd like to have had some massive liquidity events that gave us 20, 30 million bucks. And who knows, that sooner or later you're going to see something happen like that in Seed, is my belief. So,
on that note, Ed McDermott, CEO of Seed Innovations, thanks very much for your time.
Thanks, gents.
This podcast was brought to you by Roast PR Limited. If you would like to appear on a future episode of The Sunday Roast, please email admin@thesundayroast.net.